So you're thinking about buying a new car, and you're also probably thinking about financing that new car. But before you finance that car, it is extremely important that you know how not to fall upside down, or what we call falling into negative equity when buying that car. And if you're new to the channel, hi, my name is Matthew Long, and on this channel, all we talk about is making money, saving money, and how to better invest. So in today's video, we're going to talk about when you go out to buy your new car, and if you finance your car, what is the right way or how to buy your car and finance it so you don't fall victim to getting into negative equity. So what exactly is negative equity? So the textbook term for negative equity occurs when the value of the car that you just recently purchased falls below the actual finance or car note used to purchase that car. So think of it like this: you buy a car and the car's value starts to go down. However, the loan amount is higher than what the car is worth. This negative equity is a very sticky situation and one that you do not want to be in. So here are 5 tips that can help you next time you get to the car dealership and you want to go buy to finance your next vehicle, that will help you keep you out of this bad situation of falling upside down or into negative equity on your car purchase. So to start, just remember, this video is not about negotiating a car price. It's simply about how we budget properly, so when we find this awesome new car or truck, we stay within our budget and we don't fall victim to getting into negative equity. So before we begin, let's take a look at the budget and what you should stay for your car transportation. In previous videos, I've always said you want to be at 10% of your gross monthly income when buying and financing your vehicles. An example of this is, let's say your monthly gross take home is $3,000 after taxes. So 10% of $3,000 monthly would give you a car payment of $300 or less. So as long as you're 10% down, you're in good standing with your car payments. So for tip number 1, next time you're out looking for your next car, remember the 24-10 rule. When you're buying your car, tip number 1 is try to put 20% down on your next car. The more down payment you can put down, the less you have to finance. It's easier to stay in budget. And I had mentioned earlier about that 24-10 rule. So what does the 4 in the 24-10 rule apply to? 4 means the ideal finance term is 4 years. So for tip number 2, try to finance your vehicle on a shorter rather than a longer term note. The chart below me gives you an example of the car's value over time as it depreciates. You'll see that a 5-year compared to an 8-year loan, you'll be in a much better shape if you ever need to sell or trade that vehicle in. So tip number 3 is try to avoid unnecessary fees. That would include paint protection, nitrogen in the tires, extended car warranties. All of these fees add up, and it only puts you in a worse position of potentially going out of your budget when financing your next car purchase. So for tip number 4, while you shop around for cars, shop around for your interest rate. Go to credit unions, local banks, maybe even your personal bank. Whoever will give you the best rate, that's who you should do business with. And for tip number 5, avoid rolling in fees and taxes into your financing. If you can, try to pay upfront the taxes and any fees with acquiring the vehicle, because the more you package into the financing, the higher likelihood it goes out of budget and puts us into a potentially negative equity situation. In closing, you guys, always refer back to the 24-10 rule. Try to put 20% down, try to finance within a 4-year term, and try to keep your car payments within 10% of your monthly gross. If you do those things, you'll be in good shape. You won't fall underwater in your note. And as always, thanks for watching. I'll see you on the next one, you guys.